Gold just crashed 16% from its all-time high. Western investors dumped over $12 billion of gold positions in the last 3 weeks. CNBC is calling it a correction. Bloomberg says to wait for the dust to settle. And while you were watching the price drop from $5,500 to $4,686, something else was quietly happening. Something the financial media is not covering at all. 19 central banks were buying, not selling, buying 47 tons in a single month. The same institutions that set monetary policy, that control interest rates, that hold the reserve currencies of the world, they loaded up on gold at the exact moment retail investors were running for the exits. And I want to show you exactly why that matters, because this playbook has been run before, and the people who understood it made extraordinary gains. Stay with me. Let me give you the numbers first, because I believe in showing you the data before the narrative. Gold peaked at approximately $5,500 per ounce in March 2026. In the 6 weeks that followed, it has dropped to $4,686. That is a 16% decline. In absolute dollar terms, that is more than $800 per ounce wiped off. Now, there are 2 ways to interpret a 16% crash in a major asset. The mainstream interpretation is, the trade is over, the bull run is done, sell now and recover what you can. The institutional interpretation, and this is what the data shows, is this is a discount, a structured, engineered discount. And here is the evidence for that second interpretation. The World Gold Council released its March 2026 central bank survey last week. I want you to hear these numbers clearly. The People's Bank of China added 28 tons of gold in March, their 19th consecutive month of additions. The Reserve Bank of India added 12 tons, their 11th consecutive month. These are not small, emerging market central banks making speculative bets. These are major sovereign institutions with multi-trillion-dollar balance sheets. They have access to economic modeling that you and I do not have access to. They have inside knowledge of currency flows, trade imbalances, and monetary policy trajectories that does not appear in public reports for 6 to 12 months after the fact. And they are buying gold at $4,686. If they believed the trade was over, they would not be buying, period. Now I want to connect this to something most analysts are missing entirely. Subscribe if you want this kind of data-driven breakdown, because what I am about to show you is the mechanism, not just the trend. Here is the Fed playbook, and I use the word playbook deliberately because this sequence has happened 3 times in the last 20 years. In 2008, gold dropped 30% during the financial crisis. While retail investors sold, central banks quietly accumulated. By 2012, gold had tripled. In 2018, gold dropped 15% over 6 months. Central bank purchases hit a 50-year high that year, 650 tons. 2 years later, gold was up 40%. In 2022, gold dropped 12% in a single quarter. Central bank purchases hit a record high of 1,136 tons for the full year, the highest in over half a century. The price recovered completely within 8 months. The pattern is not a coincidence, it is a mechanism. Retail sentiment drives price down. Institutional accumulation occurs at the low. Retail sentiment reverses when price recovers. Retail chases the recovery. Institutions profit. The question you need to answer is, which side of that trade are you on right now? Now let me show you the specific signals that tell us where we are in this cycle right now, because the timing matters. The Federal Reserve's balance sheet tells a very specific story. In the 6 weeks since gold peaked, the Fed conducted 3 open market operations that drained liquidity from risk assets. This is not conspiracy. This is published in the Fed's own H.4.1 report, released every Thursday. When the Fed drains liquidity, gold drops alongside equities because institutional traders sell liquid assets to meet margin calls. This is mechanics, not manipulation. The result is an artificially suppressed gold price that does not reflect underlying physical demand. And the evidence for that underlying demand is right there in the central bank data I just showed you. Now, here is the number that should genuinely alarm you. The BIS, the Bank for International Settlements, which is essentially the central bank for central banks, reported last month that gold-backed derivative exposure at the top 5 Western banks has increased by 23% since gold peaked. That means the same banks that are driving the price down in paper markets are increasing their own gold-backed positions. They are short paper gold and long physical gold simultaneously. That is not speculation. That is in their regulatory filings. Let me add one more data point that ties this together. ETF outflows. In the last 3 weeks, Western gold ETFs, GLD, IAU, and their European equivalents have seen approximately $4 billion in outflows, retail investors cashing out. Simultaneously, the Shanghai Gold Exchange reported a 14% increase in physical gold withdrawal volume in March. Demand in Asia is accelerating while supply in the West is increasing. The gold does not disappear when ETF investors sell. The ETF is forced to sell the underlying physical gold. Where does that physical gold go? It gets absorbed by the physical markets in Asia and by central banks that are standing ready to buy. You're watching a wealth transfer in real time, and the financial media is narrating it to you as a correction. If you found this breakdown valuable, please leave a comment below with what you think is really driving the gold crash. I read every comment, and the community discussion on this has been extraordinary this week. Now, the question everyone is asking, what happens next? And specifically, how should you think about gold at $4,686? The 3 historical parallels I showed you, 2008, 2018, and 2022, have something in common beyond central bank buying. In each case, the price drop coincided with a specific trigger event. In 2008, it was the financial crisis. In 2018, it was the Fed rate hike cycle. In 2022, it was the initial inflation shock and rate hike expectations. In each case, that trigger was real. The price drop was real. But the trigger obscured the underlying fundamental picture, which was that physical demand had not declined, it had accelerated. The catalyst we are seeing now is the combination of a strong dollar, Fed communication about delayed rate cuts, and geopolitical uncertainty. These are real factors that affect paper gold pricing. They do not change the fundamental case for gold as a reserve asset. The countries accumulating gold right now, China, India, Poland, Turkey, Kazakhstan, are not doing so because they believe the dollar will strengthen forever. They are doing so because they understand that the global monetary system is in transition, and gold is the only neutral reserve asset that no government can print. Now let me be specific about the price, because I know you want numbers. The last 3 central bank buying cycles preceded gold price recoveries of between 40 and 300% over 12 to 36 months. I am not going to give you a specific price target because I believe in showing you the framework and letting you draw your own conclusions. What I will say is this: the institutions buying gold at $4,686 today are not buying it because they expect it to stay at $4,686. They are buying it because they expect it to be worth significantly more over a multi-year horizon. These are the same institutions that have the most accurate long-range economic forecasting in the world. They are not making a speculative bet. They are positioning for a structural shift in the global monetary order that they can see and that most retail investors cannot yet see. Let me close with 3 different positions because this community has investors in different situations. If you already hold gold and you are watching it drop and wondering whether to sell, look at the central bank data. The institutions with the most information are adding, not subtracting. Patience is the positioned response. If you have been waiting to add to a gold position, the mechanism I described suggests that price suppression events like this are historically the optimal entry window. The institutions are not waiting for confirmation. They are buying during the uncertainty. If you are new to precious metals and this is your first time seeing a major gold correction, this is what it looks like when smart money separates from retail sentiment. The price and the fundamental value have temporarily diverged. History says they converge, and when they do, the convergence is rapid. The data is clear. 19 central banks adding 47 tons of gold in a single month during a 16% price correction is not a coincidence. It is a signal. The question is whether you see it as a warning or an opportunity. I have shown you the historical parallels, the mechanism, and the institutional behavior. What you do with that information is entirely your decision. If you found this breakdown valuable, please share it with someone who is watching gold and wondering what is really happening. Subscribe for more data-driven precious metals analysis every single day, and I will see you in the next video. Now I want to address a question I know you are thinking. If central banks are buying, why is the price still going down? Why does it not stop the decline? The answer is that central bank purchases happen over extended periods. They do not buy all at once in a single day in a way that immediately reverses price action. They are patient buyers. They accumulate over weeks and months. The price setting in the short term is dominated by paper market activity, futures traders, algorithmic systems, and institutional desks that react to Fed statements and technical levels. Central bank buying is a longer duration signal, not a short-term price catalyst. Understanding this distinction is critical. You cannot use central bank buying as a reason to expect a price bounce tomorrow. You use it as a reason to understand where the longer-term trajectory points. Let me add one more dimension that ties this together: the dollar relationship. Gold and the US dollar have historically moved inversely. When the dollar strengthens, gold typically falls. When the dollar weakens, gold rises. Right now, the dollar index is at 104.8. That is elevated by historical standards. The Fed's hawkish communication has kept the dollar strong. A strong dollar creates headwinds for gold denominated in dollars. But here is the data point most analysts are ignoring. In countries with weaker currencies relative to the dollar, gold has not fallen 16%. In Indian rupees, gold is down only 4% from its high. In Chinese yuan, gold is down 6%. In Turkish lira, gold is actually at an all-time high. The 16% drop is a dollar-denominated phenomenon. It is a currency effect, not a fundamental revaluation of gold's purchasing power globally. The central banks accumulating gold are not doing so in dollars. They are doing so to reduce their dollar dependency. That is the structural context the price chart does not show you. The final piece I want to address is what this pattern implies for the timing of the next move. In 2022, after the central bank buying cycle accelerated, it took 14 months before gold broke decisively above its previous high. In 2018, after the central bank buying cycle peaked, gold took 16 months to recover fully and then accelerate. We are approximately 6 weeks into elevated central bank accumulation in the current cycle. If the pattern holds, and 3 historical precedents suggest it does, we are likely in the early accumulation phase, not the late phase. The institutions buying at $4,686 are not buying for a quick trade. They are positioning for a structural monetary shift over a multi-year horizon. The implication for long-term holders of physical gold is that the current paper price divergence is a temporary distortion in a longer upward trajectory. The implication for those watching from the sidelines is that the window of elevated central bank buying, which historically correlates with price lows, is open right now. One more thing that connects the central bank buying pattern to the current moment: the IMF, the International Monetary Fund, updated its global reserve composition data in March 2026. Gold as a percentage of global reserves rose to 15.2%. That is the highest reading since 1991. The institutions that govern the global monetary system are increasing their allocation to gold. This is not a speculative trend. It is a structural rebalancing away from dollar-denominated assets. The 16% price correction you are watching, temporary dislocations occur within structural trends. They do not reverse them.